The four biggest tech companies in America will spend roughly $725 billion on AI infrastructure this year. The two companies actually building the leading AI models, the ones everyone means when they say AI, bring in combined annual revenue that's a fraction of that number. That gap is either the most obvious bubble signal in a generation, or it's measuring the wrong thing entirely. Both arguments are real. This is the frontier economy. Let's look at what the data actually shows. Start with the number everyone's citing. Amazon, Google, Meta, and Microsoft plan to spend roughly $725 billion combined on capital expenditure in 2026, up 77% from around $410 billion just last year. Amazon leads at about $200 billion. Google is close behind. Meta raised its own guidance mid-year, citing higher chip and data center costs. Microsoft's CFO attributed part of its increase directly to rising memory prices. Goldman Sachs has been revising its long-run estimate upward all year, now projecting $5.3 trillion in combined capex from these four companies between 2025 and 2030, with a baseline estimate of $7.6 trillion when you include the broader compute and power build-out through 2031. None of the four companies are spending this because they want to. They're spending it because being short on compute in this market is more dangerous than overspending. If a competitor can serve customers you can't, that customer doesn't come back. So all four are racing at once, essentially daring each other to blink first. And that's before counting Stargate, a separate $500 billion infrastructure venture between OpenAI, SoftBank, and Oracle, announced specifically because OpenAI itself doesn't own enough compute to meet its own ambitions. Here's the part that deserves more attention than it gets. Not everyone reads the spending versus revenue gap the same way, and the bull case has real numbers behind it. Start with Microsoft. Its AI business alone, not the whole company, just AI, has already surpassed a $37 billion annual revenue run rate, up 123% year over year. Its commercial remaining performance obligations, meaning contracted revenue not yet recognized, stand at $627 billion. Google's cloud backlog exceeds $460 billion. When a Jefferies analyst was asked about the bear case earlier this year, his response was blunt. The bear thesis is garbage because the revenue growth already justifies the spending. Then there's Anthropic. In April, it crossed a $30 billion annualized revenue run rate, up from roughly $1 billion just 15 months earlier. By its most recent funding round, that figure had climbed to $47 billion. More importantly, the company is projecting its first ever operating profit for the second quarter of 2026, with gross margins on inference reportedly above 70%. That's not a company burning cash with no plan. That's a company approaching real profitability while scaling faster than almost any software business in history. The hyperscalers aren't just betting on their own AI products either. They're renting compute to everyone else building on AI, including both frontier labs and thousands of other companies. The $725 billion number isn't only building models nobody will pay for. A meaningful share of it is infrastructure being sold at a markup to paying customers who aren't Amazon, Google, Meta, or Microsoft. Here's a complication that neither the bull case nor the bear case usually mentions. These revenue figures don't mean what they sound like they mean. When a company reports an annualized revenue run rate, that's not the same thing as revenue it has actually collected. It's this quarter's number multiplied by 4. One venture capitalist told TechCrunch this year that he's directly seen companies where contracted revenue runs 70% above what's actually been recognized. The gap between money that's signed and money that's in the bank. So when two different sources cite two different revenue figures for the same company in the same month, that's often exactly why. They're measuring different things, both honestly, under the same label. OpenAI's own numbers illustrate the tension directly. Its revenue run rate reached roughly $25 billion in February. Real, fast growth by any historical standard. But its operating margin was reported at negative 122%, meaning it loses more than $1 for every dollar of revenue it books. And the company isn't projecting profitability before the end of the decade. Growth and sustainability are not the same question, and a headline revenue number answers only one of them. So is this a bubble? The market itself hasn't decided. Investors are already voicing real unease about the spending pace. One investment firm's managing director put it bluntly, warning that a historically capital-light company could be turning into what he called a capital-intensive incinerator. That's not blind faith, that's the opposite of it. The honest read is this: the spending is real, the revenue growth is real, and the gap between them is real too. What nobody can tell you yet, not the bulls, not the bears, not the companies themselves, is whether that gap closes because revenue keeps compounding or because the spending eventually has to stop. That's the frontier. Back to your inbox.